In the next 2 fiscal years, the Indian government is slated to inject 2,354 billion rupees into a massive maritime defense pipeline. To put that figure into perspective, it represents roughly 3.1 times the combined current order books of India's 3 largest publicly listed defense shipyards. This capital influx is driven by 2 simultaneous macro forces: a rapid geographical diversification of global supply chains and strict state-level mandates forcing the domestic procurement of critical infrastructure. For capital allocators, heavy infrastructure presents a distinct problem. We have to figure out how to deploy funds to capture this secular growth, while mitigating the severe execution and capital expenditure risks inherent in building massive physical assets. This flowchart maps the sovereign capital as it cascades through 4 distinct tiers of the Indian maritime value chain: primary shipyards, ports and logistics, energy logistics, and ancillaries. Outperforming the broader market during this cycle requires identifying exactly which layer of this hierarchy commands the greatest pricing power and the deepest structural moat. Starting at the top tier, major public sector shipyards like Mazagon Dock and GRSE currently possess total revenue visibility through the end of the decade, strictly funded by sovereign defense budgets. Because this top-line revenue is effectively guaranteed by the state, analyzing these equities relies almost entirely on tracking their execution velocity, how fast they can actually build and deliver the hulls. This chart illustrates a classic revenue S-curve. As these major yards mature past initial capital outlays and progress along this curve, their margin profile predictably shifts. Adding Cochin Shipyard reveals a strategic anomaly. Their trajectory diverges aggressively upward. Cochin Shipyard is executing an aggressive pivot away from pure sovereign defense reliance. They are moving to capture market share in the global commercial shipbuilding sector. The timing of this pivot directly exploits the current capacity crunch constraining commercial shipyards in East Asia and Europe. To close the engineering gap quickly, Cochin Shipyard formed a 50-50 joint venture with the South Korean shipbuilding conglomerate HD KSOE. This specific technology transfer gives Cochin the immediate capability to bid on and construct highly complex, high-value commercial tonnage that was previously out of reach. Sovereign defense contracts provide a baseline of safety and long-term visibility. However, capturing global commercial market share through strategic technology transfers provides the actual catalyst for valuation multiple expansion. Moving 1 tier down the value chain, we shift from the shipyards constructing the physical assets to the port operators controlling the actual bottlenecks of global commerce. A seaport is essentially just a concrete dock until it integrates its hinterland logistics. By connecting the port to inland rail and warehousing, operators create sticky, pull-based supply chains. This map details the physical asset base of Adani ports and Special Economic Zone. Looking at the operational statistics, this integration requires a massive scale, specifically operating 12 multimodal logistics parks and 68 container rakes. Transitioning a business model from a standalone port operator into an integrated transport utility locks in industrial customers, generating highly predictable, annuity-like cash flows. This chart shows the financial result of that integration. APSEZ's consolidated return on capital employed demonstrates consistent improvement, moving from 12% to 15%. Lower charts indicate gestating logistics and international businesses should achieve double-digit ROCE within 3 to 4 years. We see a similar reliance on logistical scaling when examining the aggressive capacity expansion underway at JSW Infrastructure. JSW's 2030 roadmap tracks their objective to more than double overall capacity, leaping from 177 million tons to 400 million. We can validate this by isolating the pipeline already in motion, including approved brownfield expansions at Jaigarh and Dharamtar. The critical de-risking metric for JSW's expansion is their ability to successfully reduce reliance on cargo generated by their own parent company. This specific operational breakdown shows a distinct shift in their customer mix toward external clients over the last year. By the fourth quarter of FY25, third-party cargo grew to account for exactly 50% of total volume. These robust operational metrics cascade directly to the bottom line. This visualization shows how diversified volume growth results in steep upward trend lines and massive compound annual growth rate expansion for both EBITDA and profit after tax. True infrastructure moats are built inland. By integrating rail and storage, these operators transform highly cyclical shipping volumes into locked-in, high-return logistical utilities. Moving beyond traditional dry bulk and containerized freight, we reach the specialized transport and storage of hazardous liquids, gases, and offshore energy assets. The economic moat in this subsector relies on massive capital barriers to entry. When combined with intense regulatory oversight, operators in this space command significant pricing premiums. Aegis Logistics exemplifies this dynamic. They operate a network of liquid and gas storage terminals strategically positioned across the entire length of India's coastline. Handling volatile substances like LPG and ammonia requires complex, dedicated pipeline infrastructure and highly specialized cryogenic storage tanks, creating a specific capital expenditure barrier that insulates Aegis from broader logistics competitors. Applying this same thesis to extreme marine engineering brings us to CMEC Limited. CMEC operates a highly niche fleet of diving support vessels, providing mission-critical underwater maintenance, repair, and subsea construction for the deep-sea oil and gas industry. The immediate corporate catalyst for CMEC involves navigating a complex restructuring phase under the National Company Law Tribunal. This process, involving parent entity HAL Offshore, is designed to streamline its asset base and de-risk its overall business profile. Their revenue model remains insulated, relying entirely on high-margin vessel deployment charters and fixed lump-sum contracts for highly technical rescue and construction operations. Operating in highly regulated, extreme environment niches create localized monopolies. These firms command premium margins that remain completely insulated from the broader commoditized logistics competition. This brings us to the final, deepest layer of the maritime value chain, the specialized ancillary ecosystem, which houses highly profitable proxy investments. These agile micro and small-cap engineering firms possess a distinct structural advantage. They extract superior profit margins from the shipbuilding cycle without bearing the heavy capital expenditure burdens required of primary shipyards. The primary catalyst forcing capital into this specific layer is a set of strict government indigenization policies, which mandate the domestic procurement of marine components. Knowledge Marine and Engineering Works serves as a direct, high-margin proxy to two major government infrastructure initiatives. As Indian ports aggressively phase out aging diesel fleets to meet 2030 targets, Knowledge Marine is positioned to supply and operate the incoming zero-emission craft. We see similar alpha extraction in critical metallurgical components by analyzing Krishna Defense. The company holds an absolute domestic monopoly on proprietary welding alloys required for military-grade steel, as well as specialized products like bulb bars. These bulb bars are an engineering necessity. They act as structural stiffeners that exponentially increase the strength-to-weight ratio of massive warship hulls. Krishna Defense's immediate growth trigger comes from recently securing stringent DNV and ABS class certifications. These new international certifications allow the company to instantly expand its addressable market, moving beyond isolated naval defense contracts and directly into the booming commercial shipbuilding sector. These specialized proxies provide a way to capture the same growth trajectory as the primary shipyards, but with a fundamentally different margin profile. By monopolizing mission-critical components, they avoid the multi-year, multi-billion-dollar capital outlays required to build the actual hulls. Zooming back out to the macro perspective, we can see the 2,354 billion rupee capital expenditure cycle moving through the industrial economy. Looking at our mapped value chain, primary shipyards offer deep revenue visibility but require capital-heavy execution, while port operators demand massive physical footprints to generate annuity-like returns. The ancillary tier provides a capital-efficient way to participate through high-margin components with deep competitive moats. This entire ecosystem is backstopped by two unyielding macro engines: the geopolitical necessity to diversify global supply chains and strict, immediate import substitution mandates. The alignment of state capital and indigenization mandates has turned the Indian maritime sector into a strategic component of global trade infrastructure, offering a multi-decade compounding opportunity for long-term capital.